on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Toyota Chairman Akio Toyoda is expected to retain his board seat at the automaker's annual meeting today, despite concerns over his role in a controversial group company takeover. Let's bring in Bloomberg Intelligence senior analyst Tatsuo Yoshida. Tatsuo, of course, we are watching the Toyota Industries privatization, but also at the same time, there have been some concerns about corporate governance around Toyota and around Akio Toyoda even before this.
Oh, yeah, that is correct. And recent move to the privatization of the Toyota industry, that kind of amplified the concern.
But what is the issue with Toyota Industries? Because you would think the Japanese government wants to simplify these cross-shareholdings. Wouldn't this be actually a good thing?
Actually, that is a plus. That's a positive aspect of this privatization. But looking at the structural ownership of the Toyota Industries, it's owned by the Toyota Fudosan, used to be Towa Fudosan. That holding, almost like a holding company, holds 99.5%, and then Akio Toyoda has remaining 0.5%. So it's the Toyota industry is owned by the so-called Toyota Group.
What are the biggest concerns from major investors about governance?
Actually, governance-wise, too much influential power of the Toyota Group as well as the Toyota Akio Toyoda.
So what is Akio Toyoda saying himself? How is he justifying this?
Actually, Akio, he himself said, I'm not going to influence the company too much. Instead, this is more like a symbolic role.
We have to take his word at face value. Okay. That was great to have you with us, Tatsuo Yoshida, Bloomberg Intelligence senior analyst. Heidi, of course, as we continue to watch the Toyota stock, we'll be watching that trading as we get the annual general meeting today.
So, Sherry, we're watching this survey by Bloomberg Intelligence finding that over 64% of car buyers are opting for new energy vehicles versus 57% last year. It's mainly being driven by an interest for plug-in hybrids. Let's get to our Bloomberg Intelligence China auto analyst, Joanna Chen, who joins us out of Hong Kong. So tell us about the takeaways from this latest China car buyer survey.
Yes, hi. So our car buyer survey basically serves as a lead indicator to show how consumer preferences and also market trends are evolving across markets. We do that in China, in Europe, the US, and also Japan. So to your question, in China, we are definitely seeing the new energy vehicles continue to gain more interest and continue to squeeze out the traditional gasoline cars out of the market. Yes, we definitely saw that 64% of our survey respondents saying that they want a new energy vehicle versus 57% last year. And if we break down the numbers, it's a little bit more interesting. We see that battery electric vehicles are still the most popular powertrain, with 1/3 of survey respondents saying that they want a battery EV for their next purchase. But if we compare that to the 2024 result, it's basically flat line. So what's really driving the rise of interest in new energy vehicles is actually the plug-in hybrids, according to our survey. And that's because some consumers are still worried about the battery performance and charging concerns. We are seeing that this kind of ultra-fast charging technology is emerging in China, but infrastructure will take time and investments to keep up. So until that is ramped up, we think that plug-in hybrids will still be one of the pretty dominant powertrain in China, and that that means that for automakers, they probably need a very strong and balanced model portfolio in both battery electric vehicles and plug-in hybrids so that they are set for long-term sales strength in the market. Because for the next couple of years, we're still seeing that battery EV and plug-in hybrids coexisting in the market.
So we can see right now the subtle differences between the 2024 and 2025 survey when it comes to brand popularity. But tell us a little bit about the competition. How competitive is this environment? Because, of course, the key issue right now is the bottom line.
Yes, the competition is fierce in China. We saw we asked them what are the brands you're preferring for your next purchase. We do see a lot of reshuffling, and overall, the homegrown brands are gaining more interest in our survey. And we see that BYD climbed to the top, and then Tesla slide to the second place in our ranking of most popular brands. And what really is kind of different in our this year's survey is that Xiaomi climbed really fast to the fourth place, and the votes are only marginally below BMW. Xiaomi, they only debuted their first EV in early last year, and it's just been a year, and their EV, like the SU7, is outselling Tesla's Model 3. And, people are waiting for 11 months to get delivered if they place an order for a Xiaomi car. So we think the demand hasn't been fully reflected in sales number because of their production bottlenecks. And once Xiaomi ramps up their second SUV model and also the second factory, that makes Xiaomi a really serious contender in the China EV market that will give more competitive threat to especially like Tesla and NIO, whose EVs are priced similarly versus Xiaomi.
We've seen more than 2 years of hyper-competitive price wars, right? Has that done damage when it comes to brand reputation? Is that really a key sort of marketing focus now for these makers?
We are definitely seeing that because of the price competition, brand loyalty has been plunging. More and more consumers saying that they are likely to jump to other brands, or they have no preferences in terms of which brands they look at, and they are more caring about product specs and also the pricing and other kind of more related to product itself instead of the branding. So that means the competition is rife for automakers. They have to make their products really competitive in terms of pricing, specs, and also software to attract the Chinese consumers. They don't really have much pricing power in this market. It's consumers who make decisions now.
Bloomberg Intelligence China auto analyst Joanna Chan there. Take a look at how we're setting up. We're just about 12 minutes away from the start of cash trading here in Australia, also in Japan as well. Asian stocks are looking like we might see some renewed downward pressure risks right after President Trump saying again that he'll set unilateral tariffs in 2 weeks, planning to send letters to trading partners in the next 1 to 2 weeks ahead of that July 9th deadline. He has threatened to impose those high duties on dozens of economies. At the moment, we've only seen a trade framework with the UK, a truce without many details with China that was recently under threat as well. But a lot of other bilateral deals are still sort of in the state of discussions, including major ones, the likes of Japan, India, South Korea, the EU still very much up in the air. Sydney futures up about 0.2%. We're seeing some negativity last traded when it comes to Nikkei futures, and S&P futures also looking a little bit softer as well. We see that haven demand starting to play out as well. The undermining of the US dollar continuing to be that narrative. We could see a bit of an edge when it comes to Asian currencies already getting that boost from the slide in Treasury yields. We had, of course, the benign inflation report overnight as well. That sort of fears of a reacceleration in prices, and now more expectations of Fed support are kind of more in play in that market mood. More ahead on the Asia trade. This is Bloomberg.
on the opening trade.
What trade does is it meets a consumer demand. Consumer demand is not weakening. China supplies a little over 30% of what we eat, wear, and consume. That's unlikely to change anytime soon. I think that supply will find new homes potentially, but our reliance as a global economy on Chinese manufacturing is unlikely to change fundamentally anytime soon.
Don't miss the opening trade live every weekday.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
DoubleLine Capital CEO Jeffrey Gundlach believes America's debt burden and interest expenses have become untenable. They may lead investors to move out of dollar-based assets. He spoke to us exclusively at the Bloomberg Global Credit Forum in Los Angeles.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that. So the previous group talked about capital flows, and one of the reasons that the U.S. is underperforming at this point is so much money came into the United States since, say, 2015 or so, or 2005. And there was a net investment position. Foreigners were investing more in the U.S. than the U.S. was investing outside the country, to the tune of $3 trillion. That was about 15, 17 years ago. It's now over $25 trillion is the net investment position, and the dollar is falling. So it's not inconceivable that some of that $25 trillion that came in over just a couple of, not even 2 decades, could go out. And so this is a moment where finally you have the setup where non-US investment, even if you're a dollar-based investor, you should be thinking about increasing your allocations to non-dollar investments. And it's already working. It's already working.
So there's so much to unpack there. I want to talk about the idea that there could be this 25 trillion or some of it that moves away from the U.S.
Trillion.
Right, exactly,
Yeah.
whatever it is,
Yeah.
3 trillion. You're getting trillions of dollars moving out of U.S. assets.
Yeah.
How high or what kind of behavior do you have to see in the 30-year bond to like it again, given the fact that you've been very vocal
I've been
about
thinking
shorting
about
it?
this for a long time, and I've come to the idea that as the Fed eases, and when the economy really does weaken more, the Treasury rate will continue to go up at the long end. And so for now, we're very uninvolved in the long-term Treasury bond. But there will come a moment where you have to pivot, because there's going to be a response. And I've got many ideas of what that response might be, but one of the leading candidates would be quantitative easing. So you get to a point where the rate is so uncomfortably high. What is that number? I'm going to guess 6%, where they say this is going to be something that we're going to be running a $5 trillion budget deficit with all this bond issuance when we go into a recession. And so they'll pivot. I believe this is a sensible idea. There's other ideas too, but the leading candidate is they will announce quantitative easing.
DoubleLine Capital CEO Jeffrey Gundlach there, speaking exclusively with Bloomberg's Lisa Abramowitz. Let's get to some of the morning calls that we're watching ahead of the Asia trading day. PIMCO sees a tactical opportunity for long-dated Japanese government bonds after a surge in the 30-year yield to record highs. Global Fixed Income CIO Andrew Bowles told Bloomberg that the bonds look really interesting. He also told us that he views it as a short-term trade rather than a long-term play. Hedge fund founder Paul Tudor Jones expects the US dollar to weaken another 10% over the next year as short-term rates fall sharply. He also believes President Trump may appoint a, quote, uber dovish Fed chair to support his growth agenda when Jerome Powell's term ends next year.
Short the dollar? I mean, you mentioned you're into yields curves.
I would say that the easiest long-term trades are You know the yield curve's going to steepen, probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that. A lot lower because of that.
How much lower? We're off 10% from our high right now, 8%.
Yeah, I would say I think that's a year from today, that's probably a realistic assumption.
We're following the bond market moves, but on this trading session across Asia, we're seeing a little bit of that risk-off sentiment, with President Trump now saying that he'll set unilateral tariff rates within 2 weeks. This is Bloomberg.